In the world of investment and trading, the Nasdaq has always emerged head and shoulders above all the other exchanges, especially for retail traders looking for high growth. The potentials for disrupting technologies, redefining entire sectors, alongside with the possibility of exponential growth of their individual share price, has encouraged many titles to begin their adventures here in order to become tomorrow's titans. It's normal for traders in this case to also want to navigate those exciting and yet volatile waters in order to identify a precise way to capitalize on the defining enterprises of tomorrow. After all, this is one of the birthplaces of the modern economy, based on the connectivity, speed, and analysis using the tools and technologies of a new era. Amongst all the titles that may bring us wealth and prosperity, there is Palantir, a long-term stock market darling over the past few years. The data analytics firm is based in Denver, Colorado, and has been an enigmatic company to cover ever since it went public on the Nasdaq, with a reputation shrouded in mysteries and controversies. As a data aggregator and analysis platform, it has one of the deepest pockets in terms of relationships in town. Their corporate and also like public sector contracts go into sectors such as healthcare, defense, and intelligence analysis. Its price action is directly linked with the company's own fundamentals and risk appetite of the market, and with an increasing institutional participation in the company, there may be a lot more potentials to where the share price might go up. Before today's video continues, if you would like to see more stock analysis videos like this one, please consider to like, comment, and to subscribe to my channel. So, in recent market activities, Palantir has stabilized around $16.39 level, recording a modest uptick of around 2% over the past 5 days, and a more significant downturn of 8% in the last month. While these short-term movements may not carry immense significance in a larger context, factors beyond fundamental considerations contribute to those fluctuations. The current market environment is marked by fewer traders and decreased news circulation, creating a relatively calm atmosphere. Despite these conditions, Palantir maintains an overall positive trend, demonstrating commendable performance throughout the year. The prevailing sentiment here is that amongst investors, people are generally speaking looking favorably towards Palantir, recognizing it as a noteworthy company with innovative technologies crucial to many businesses, and I want to say country as well. However, a notable concern arises from Palantir's significant reliance on the public sector, resulting it into being a somewhat top-heavy and less diversified shareholding structure and business model. Despite being a known aspect of Palantir's business model, this dynamic likely influenced its current valuation. Also, as Palantir's clients primarily operate in the real economy, the potential budget cuts from the individual level research and analysis of those companies may pose a problem. Nevertheless, Palantir has demonstrated its capacity to not only to generate profits and to maintain self-sufficient cash flow, but also navigate the evolving trends in the world, such as with the artificial intelligence and large language models. Another aspect to consider is that Palantir's motivation goes way beyond purely economic factors and reflect its deepest origins. After all, Palantir serves entities that may be too sensitive for like purely commercial companies to engage with, aka Alphabet, providing a key competitive edge over other rivals in the sector. The fundamental profitability of these ventures remain uncertain, of course, and sometimes may even cost it dearly. But Palantir undeniably gained momentum and notoriety in the market throughout 2023. As we navigate the dynamic landscape of 2024, it's essential to observe how Palantir adapts and capitalizes on the emerging trends. With that being said, here's a quick look at the technicals. The trading volume of Palantir has recently been around 41 million shares, compared to an average volume of 47 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be easy to influence the stock price, but with low liquidity, it could also mean that the demand is limited as well. The market cap of Palantir is currently at around $36 billion, compared to an enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is 7% higher than the 1-month low, 17% higher than the 3-month low, and 188% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is, the implied volatility is around 54% compared to a historical volatility of 46%. The put-call volume ratio is currently at around 33%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions with put options. The most recent volume of options traded is around 245,000 contracts a day versus the 30-day average of 269,000. For open interest, the most recent volume of open interest is 3.2 million contracts compared to the average volume of 3 million contracts. In terms of the shareholder structure, institutional shareholders own 40% of the total float, and the biggest shareholders include Vanguard, Renaissance, and BlackRock. Usually, it's always good to see some institutional presence when holding a stock long-term, as it offers a layer of stability and reliability. It also means that the market at large believes that it will deliver value in the long run, which is a very important factor to consider for the investors. I personally believe that a minimum threshold should be around 25 to 30% for institutional ownership. The current short interest is around 6% of the total float, 53% of which from the dark pools. Typically, if the short interest is above 15% of the total volume and a significant portion of the shorts from the dark pools, there might be an argument for the presence of a short squeeze. However, it's not the case here with only 6% of the total volume being part of the short. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, Investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. So, to sum things up, I believe that Palantir will endure as a significant player in the coming years, even amid the current unpredictable fluctuations and volatilities in its stock caused by unforeseen circumstances. As a result, it seems prudent to gradually establish a position over time, paying little attention to short term ups and downs in prices. This approach assumes that a portfolio is in line with a suitable risk tolerance for technology stocks. Now, I would recommend to commit between 3 to 5% of portfolio in Palantir and to split the allocation in batches of 20% at a time over the next few months